Well, I think that the Commission, I mean, most of the attention's been on the ring fencing proposal and the way to split up retail banks from investment banks. But the key thing that stops a bank failing is having enough capital and having enough liquidity. Now, those are two issues that have been dealt with quite extensively by international regulation and have been a particular focus of the Bank of England and the FSA here. And so that our banks are now carrying a lot more capital than they were beforehand. In other words, they've got a lot more money set aside so that if they do lose money on a bad loan, they can afford to pay for it. They've also got a lot more liquidity, insofar as they've got a lot more everyday, they've got a lot more cash reserves, so that, if the wholesale funding markets, the international money markets freeze up, most of our banks can now go more than a year with those markets completely frozen, and they'll be fine. They've still got enough cash. And, back before the crisis, back in 2007, 2008, that was more like about 2 to 3 months, and so that's what we had. We had those wholesale markets freeze for 2 to 3 months, and then the banks were over. Then, in terms of the reforms, I mean, the reforms kind of enshrine a lot of that stuff that's already going on in the international sphere. And the thing that they've focused on with the ring fence is making sure that if a bank does fail, it's small enough to be dealt with by a country like Britain that's got banks that are much bigger than the economy. And the reforms should, in theory, do that, but the question is, what's the price of that? What cost is attached to these reforms, and is the cost justified, given that lots of other countries aren't doing this, and so Britain is out on its own, and is the juice worth the squeeze? Does it put our banks at an unfair disadvantage to foreign competitors? Does that have an impact on the economy? The Commission's answer to that was broadly no, not really. But it is quite interesting to look at what they define as, the social cost. They talk about the social cost in the report, and that is quite a narrow definition in their view, as far as I can tell, to refer to the state and refer to cheques written by taxpayers to pay for failed banks. Whereas the broader economic cost they refer to it was part of their remit, but it does seem to me that when they talk about the cost, the broader cost, they're really interested in how much do taxpayers sign as a cheque, what taxes come into the exchequer. They're less interested in how much does a mortgage cost the man in the street, and how much does a loan cost a small business.
Well, first, what's absolutely essential is that ministers shouldn't be diverted by these longer-term reforms from the pressure on banks to ensure there's more credit getting through to our businesses, particularly small businesses. We had the Merlin Agreement this year. There's going to be more next year. We want to keep on the pressure to make sure that businesses actually get the money they need. Secondly, it's absolutely clear right at the top of government that we don't want to do anything to put British banks at a disadvantage to other banks, for example, French banks, Deutsche Bank in Germany, or Bank of America in America, given what's happening internationally. So what's very important is that reforms that we make here do dovetail with what other countries are doing to their own banking systems. We have got some very successful world players here. Barclays, HSBC, Standard Chartered, RBS to a certain extent, and we want to make sure those interests aren't damaged. Thirdly, it's absolutely vital to make sure that the reforms we make now to our banking system do suit our wider agenda of getting the economy going again. We want growth in the economy. Having more stable banks having good banks helps good growth. So that's extremely important. Good banks give us good growth, and the small business sector can start to recover. The fourth reassurance I can give is that there is no disagreement at the top of the government between the coalition partners on this. You've got the Liberal Democrats, Vincent Cable and so on, absolutely at one with George Osborne on the scale of the reform that's needed.
The critical thing that's come through is the need to create a ring fence for the retail banking activities. That is for the ordinary retail customers and the SME businesses. Vickers then goes on to say that corporate businesses may fall on either side of the ring fence, so allowing banks some flexibility. But the key thing is to create a firm and subsidiarised entity which will look after the interests of the bank in respect of its retail customers and SME businesses.
Well, the 2019 date is a long stop date that the Commission have set. They said they want all these reforms completed by this date, and George Osborne has accepted that. Now, 2019 is a long way away. Obviously, some of this work will start immediately. There's nothing stopping the banks. They need to get on now with harmonising their IT systems to make people's ability to switch accounts much easier. They've got to get on and deal with their ring fences now, what they want to put on the retail side, what they want to put on the investment side. All that kind of work can get on immediately. Some of the changes needed to the legislation obviously will be phased. We've got some legislation going through at the moment. We may need a separate banking bill. Some of that work will be phased. And there are other reforms in play. We're setting up a new financial conduct authority, for example, that won't operate till 2013. And it will take time for the challenger bank that Vickers envisages to become fully functional and challenge the other banks. So this is going to be quite a lengthy process. Vickers sets 2019 as the long stop date. And we've now got to look at the detail of his recommendations to see which ones come first.
The Commission has made clear in most of its work that they don't really see investment banking as being necessarily more risky than retail banking. I mean, it's more volatile, it's got more ups and downs. And, you know, the way it's been characterised, certainly by most of the politicians, is that, you know, risky investment banking, casino investment banking, as the politicians have decided to call it, is the risky thing, and that's what's going to sink all our banks. And, you know, most of the losses that our banks suffered over the crisis were actually on property lending. It was on, you know, mostly on commercial property, on you know, mortgage lending. It was on that type of stuff. That's what they lost, according to the FSA. It's off the top of my head, but the 75% of the losses that Britain's banks suffered were on property lending and the type of stuff that you would maybe expect to be in a ring-fenced bank. You know, the bank that would be implicitly backed by the state, that would be kind of seen as being more safe. And the Commission acknowledged that. Their role, they saw their job was to just find something that when the next time there is a future crisis, because they acknowledge there will be more, the next time there is a crisis, it will be something that they can deal with, that we as a people can deal with. And it won't be a big sprawling mass where, you know, you need to save all kinds of other things to save the stuff that you want to save, namely, you know, the payments system, you know, the thing that keeps wages dropping in your bank account and allows you to pay your gas bill and withdraw cash from an ATM. They want to keep all that stuff without necessarily saving loans to Russian oligarchs to build chemicals plants in Latvia. You know, that's the type of distinction they want to make. And but yeah, it does come back to this issue. They talk about, you know, social cost is the phrase that they use in their report, and social cost refers to, you know, money paid by the government to stop stuff happening. It doesn't refer to how much your mortgage costs. And given that there's been a big conflation in the broader debate about these kind of broader issues, and that the problems of the banks are associated in most people's minds with the fact that it's now more expensive for them to get a mortgage, I mean, the Commission thinks that's a good thing. The Commission thinks it's a good thing that you find it tougher to get a mortgage. They want less people to be borrowing more they can afford to pay back, as they rightly see that as a cause of the crisis. So it's an interesting intellectual opposition that is there in the report, really.